Hello, and welcome to Idea to IPO. I'm Jason Putnam Gordon, a venture capital and emerging growth company attorney with Pulcinelli. I'm based in San Francisco. I'm joined today by Emily Mann of Redpoint Ventures, David Reznikov of Great Point Ventures, and Sean Lee of Mubadala Capital Ventures. Today, we're going to discuss the latest innovations and investment in fintech. We've got a great panel. Before we get going, I'm going to tell you a little bit about the overview of the process today. First, today's event is recorded. Upside is, if you miss some or all of it, we'll follow up afterwards with the recording. Downside is, not only is it not confidential what you'd share with us, but it's going to be memorialized for posterity. So please think before you say or chat in this case. We're going to have the panel talk for about an hour today. And then we'll follow up taking Q&A. For Q&A, please use the Q&A function. That is the question and answer function. Don't use the chat. Feel free to chat amongst yourselves, and I'll try and monitor the chat too and maybe respond to it. But the Q&A is going to be the best way for us to target getting your questions and getting them answered. Now, I think that's about it. Other than that, the only other pro tip I have for the audience members is to please fill out your audience survey, okay? Because that's going to give us a sense for who's in the room, and we're going to get the best chance to kind of tailor today's conversation towards it. So with that in mind, nobody's come here to see me. They want to see and hear from the panelists. We'll start with Emily Mann, who can tell us a little bit about herself, about her fund, and what they're interested in and how they play in fintech. Emily?
Awesome. Yeah, no, thanks for having me here. I'm really happy to be here and love fintech, so excited to chat about it more. I have been fintech investing for the last couple of years, most recently at a firm in New York that focused on fintech infrastructure exclusively, and so have kind of seen the evolution over time over a couple of different spaces. Redpoint, we are a Bay Area firm. We invest across all stages from seed all the way through IPO. And we are generalist investors, but have spent a lot of time in fintech historically. Some of the investments that we've made include Stripe, the payment processor, Nubank, which is a neobank down in Brazil, as well as on the insurtech side, Root Insurance, which is a direct-to-consumer online auto insurance company, which we recently took public, as well as Next Insurance, which is focused on sort of small business insurance products. And then last but not least, Ramp, which is a corporate card company based out of New York, focused on small and mid-sized businesses and providing them a full suite of spend management. So we've spent a lot of time in fintech across a bunch of different spaces, and I'm happy to talk to some of the trends.
Fantastic. We're delighted to have you here. Sean, would you tell us a little bit about yourself?
Sure. Great to meet everyone, and thank you for having me. Delighted to be here. My name is Sean, and I'm a principal with Mubadala Ventures. We are the VC and growth equity arm of Mubadala, which is one of the world's largest sovereign investors at $250 billion in assets under management. Our team oversees strategies that focus on partnering with visionary founders to build enduring technology companies globally across US, Europe, MENA, as well as broader Asia. I spend all my time as a fintech investor on the team here in the Bay Area. I've been fortunate enough to partner with some leading companies in the space, including the likes of Rex, which is a corporate expense management card, as well as a full software platform for the SMBs, C2FO on the working capital financing side, Cardless, which is a credit card issuance as a service platform specifically for underserved consumer brands, Welcome Technologies, a neobanking platform for Hispanic immigrants coming to America, along with Gabby Insurance, which is a leading online digital insurance brokerage platform. So as an institution, we help companies through the entire life cycle of their funding from a capital perspective all the way to IPO, as well as we leverage the global network of Mubadala, where we're active across 50 countries and 15 sectors to really help them continue to thrive and grow on a global scale.
Fantastic. We are excited to have you here, Sean, and we're excited to have David here as well. David?
Hey, everybody. I'm an associate partner at Great Point Ventures. We're based in San Francisco. So we are, a $1 billion AUM fund with a B2B focus, pretty generous across B2B. But it's fintech bets we have so far include businesses like Extend in the warranty space, and then InsurTech businesses like Sidecar Health. And then me personally, over the last 4 years, I've been investing in fintech all around the world, actually. Everything from businesses like Flutterwave in Nigeria to Brex, which is obviously SF-based, Deal as well. And yeah, always looking for more.
Fantastic. So before we kind of open up the panel for discussion, it looks like I got a question or a comment regarding the survey function not working. I think that might just be unique to that individual. So you might want to close it and reopen it if you can do that. And let me tell you a little bit about who is in the virtual room today so we can try and tailor our discussion towards them. So we've got about 30% of the folks from the Bay Area, another 7% from elsewhere in California, the US, another sort of 20%, and another sort of 13% from the rest of North America, a couple of folks from South America, and then roughly 10% in Asia, Africa, and Europe. Now, again, this is recorded, so a lot of the folks who have signed up will get this later because it could be in the middle of the night where they're at. So very exciting. In terms of what stages folks are in, it sounds like we've got some first-time entrepreneurs make up the bulk of the room, 50% of the folks, and 17% are serial entrepreneurs, a few angels, a few other VCs. We got some members of the media in today's discussion, and some folks at scale-ups, and some folks at large corporates. So I'm going to share that. And kind of with that in mind, I often find it's helpful just to start with an open-ended question, which is, when we're talking about fintech today, can we talk a little bit about that landscape? What sort of fits into fintech? What is out of fintech? And kind of what are some of the sub-verticals within there? B2B came up at one point, B2C, and some others. We'll go in reverse order. Maybe we'll start with you, David, if that's okay.
Sure, of course. Yeah, I think the trope at this point is everything is fintech, right? I think that's one of the things that's getting people really excited, is that, I guess historically you could look across like banking, capital markets, and just sort of the other traditional verticals. But now, with call it like embedded fintech and the rest, we're expanding across pretty much all verticals across technology. And I think that's one of the things that are getting investors and entrepreneurs excited. And then, I'm looking primarily more on the B2B side of things. And even from that, cut the world in half, it's still exploding in terms of the activity we're seeing.
Yeah, I'll go next. I have to wholeheartedly agree with David on this one. I believe that more and more technology companies whose bread and butter is not within financial services offerings are starting to offer fintech through embedded and BaaS platforms as just enablers that's making this new reality happen more quickly than beforehand. For ourselves here at Mobotala, we look at fintech across all the sub-verticals, including payments, capital markets, banking, etc., lending, but we also unfairly include InsurTech as well as PropTech under our kind of larger bucket of fintech. So we do look at those opportunities as well. We're pretty agnostic. I think we look at both B2B and B2C. We have investments in both categories and see tremendous opportunities in both business models. So that's where we like to.
Yeah, it's hard to disagree with what both David and Sean have said in terms of everything becoming fintech these days. The way that I kind of see it is, it used to be you would walk up to, your local bank that knew you as part of the community, whether you were a business owner or an individual, and they could provide you with the services that you needed to deposit your money, give you a loan, get a mortgage. But now that everything has moved digital, you don't have that same tight-knit experience anymore. And so what that means is there are a new crop of players that might actually be better positioned to have that understanding of who you are as a consumer or as a business owner, and better positioned to, have financial services included seamlessly within the experience that they offer today. And so what we're starting to see is a lot of traditional workflow solutions or software solutions are now embedding in payments or invoicing functionality, or offering, loans or bank accounts to their end customers. And so some of the areas that we're really excited about, I guess on the direct to side, people who are taking, away a lot of the costs of old technology and outdated systems that incumbents have today and redesigning that for the digital era. And then on the other side, there's a whole host of players, whether that is software players or infrastructure providers that are allowing, anyone to offer in fintech or financial services capabilities. And that's something I'm really excited about.
That's terrific. I think that's also a great launching point. I know folks are here today to learn and hear about sort of what's the latest and greatest, both on the investment side and also on the innovation side. Maybe if we could kind of open up with a little bit of a discussion about what's happened sort of pre-pandemic, what's going on in the, in the last 12 months or so with regard to fintech, not with regard to kind of all the other things that are going on. Or focused on fintech is what I would say, and then sort of what we see, in the short, medium, and maybe even longer term future. Emily, you're shaking your head. It's meant to be an open discussion too, so we don't have to.
I mean, I have a lot of thoughts on this, and try not to hog the mic too much. But overall, I think what the pandemic did was it accelerated a lot of trends that were already happening in terms of the move to digital, and at the same time really shone a bright light on how broken some of the incumbent systems were. So if you think about just the two waves of PPP loans that the government tried to push out, and just like how much of a disaster that was in many ways, shapes, and forms. A funny anecdote from one of my portfolio companies that works with, community and mid-sized banks is the first couple of weeks of work from home, they didn't do anything because they were scrambling to just get all of their employees and executives laptops, because that just wasn't a thing that was part of their DNA. And so I think because of the pandemic, people realized like how important it was to have strong digital capabilities, whether that was as a consumer of being able to access my financial services and products digitally, or on the flip side, the banks and institutions realizing that they need to have the ability to provide those services. And so I think post-pandemic, you will continue to see a lot of that accelerate.
Yep, I agree with Emily on this. I think it's shocking how quickly we've noticed digital first solutions have been thriving through this period. I've actually served as a critical lifeline for a lot of both businesses and individuals. You'll be surprised how you would think some of the biggest banks traditionally in America are with the top PPP lenders, but one bank that you might have completely missed is the Cross River Bank. It's actually one of the top PPP lenders by volume, and Chime was able to give advances on stimulus checks faster than anyone else, the folks in the region, right? And then you also notice that the financial institutions themselves are starting to wake up and realize that, wow, the traditional way of doing business for us is no longer going to work. And some metrics and anecdotes that we've seen on our side that's really eye-opening is that HSBC closed 80 branches just in H1 of 2020. Wells Fargo shuttered 64. How do you migrate? And those are just some of the largest banks catering to big customers. So how do you think about some of the small size and medium banks really trying to continue to operations, open up new deposit accounts for these customers and businesses in a more digital first approach? And that's where we see a lot of opportunities as well, reconstruction and re-strategize of the traditional financial institutions and becoming more modern from an infrastructure perspective, as well as a continued thriving of digital first solutions and neobanks that continue to capture different pockets of the population.
I mean, I guess the only thing I have to add to that is, historically with a lot of, especially around like SMB and adoption of some of these new technologies, there's just a lot of friction, and luckily or unluckily, the pandemic accelerated a lot of that, and so it's been exciting to see that sort of adoption.
Yeah, and then maybe one other trend that I would love to highlight is I think, financial services just from a cultural perspective have become much more a part of the everyday language, right? I don't think anyone, 5 years ago talked about, where they banked or how they managed their money, but now you're starting to see, Cash App become a cultural term. You're starting to see people, meme stocks and things like that are very much part of the day-to-day cultural lexicon. And so it's kind of like financial services is moving away from something you just, needed to do and had to do to manage your money to something that people are actively having conversations about.
This is on a global scale too. We talk about Robinhood all the time. We talk about Wall Street Bets all the time here in America, but you'll notice that there's a lot of other companies who are doing similar things as well as offering differentiated, more local solutions in different geographies. Futu in China is one that continued to thrive through the pandemic, but staying relatively under the radar, right? So our paradigm of what we discuss on a daily basis has absolutely shifted and changed. So it's an exciting time. I think we're entering a golden age of fintech.
So, I mean, some of the things that I'm taking out of this discussion is sort of an expansion of services, a sort of maybe more democratization in terms of being able to reach more customers, if you will, and communicate with them, meet them at a level that they're kind of more familiar with. Can you name some of the? I think you named some of them before Robinhood, but what are some of the other examples that we're seeing here? Robinhood's obviously more on a later stage, but kind of what else is going on at the sort of scale up and maybe even earlier stage that excites you?
I think another trend, just to sort of highlight on that, is companies like Public, Canary, a bunch of the other ones where you're bringing a generation of people who used to never really actively manage their wealth, and actually start thinking about how do we gather more insights rather than just trade off of what we see online or what are the hottest stocks available. So companies like Public are really enabling people to share their ideas, follow people and influencers or important individuals that they feel have similar and aligned investment interests, whether that's on ESG or whether that's on different themes, are starting to sort of share more information, aligned to your point, Jason, more democratization, but also more access. And I think that's something that we're continuing to observe today.
Yeah, no, totally agree with that. I think, not a earlier stage scale up, but Cash App has kind of really emerged as a big player in, serving a big proportion of the people who, are underbanked or unbanked today, and managing to capture that population and give them, a basic set of tools for managing and moving their money. I think one of the trends that I'm actually really excited about is this idea of kind of going back a little bit, and it's a bit of a reversion from what I was talking about before, where it used to be community-based banking, then it was these, big national brands of your Chases and Bank of Americas, and now you're starting to see that splinter off a little bit. You're seeing a lot of early stage companies focused on specific affinities or specific groups, right? And tailoring their offerings towards serving those customer types, whether that is, a racial identity, so banks for the Black community or the Latinx community. You're starting to see that based on, people with unique financial situations, whether that's helping married couples, figure out their finances, or divorced parents on how do they, manage costs for their kids, or even like you have the green light steps currents of the world that are serving the sub 18-year-old population of like, hey, instead of mom giving me $20 in pocket money, and I can't use that for my Spotify or anything that I want to do online, like how do we provide them with both the ability to have a digital card and be part of that, but also the educational tools around it to build that financial literacy from a young age.
David, you're shaking your head.
Oh no, sorry, nodding along in agreement. Yeah, no, I mean, yeah, nothing to add. I think that was great.
So one of the things I always kind of track across the spaces, especially these days, and I think that is becoming more and more top of mind, if you will, is the ESG issues and kind of what's going on with ESG in the fintech space. And for those who are not familiar with it, we're talking about environmental and social and governance aspects to sort of build not only companies that are profitable, but are sort of better across a wider range of stakeholders than just their stockholders, if you will. Be interested in getting your thoughts and comments on that.
I can start. I think it's actually changed how we invest in companies. We're very early innings, at least within the bottle up, but just being completely transparent from our side, we're actually starting to add more of diligence items related to ESG within the framework when we evaluate companies on the global impact around environment and governance and so forth. So it's on the top of our agenda, top of our minds. We're continuing to work through it, and we know we're going to potentially make mistakes at the beginning, but we're being proactive as an organization across all our different strategies to incorporate ESG within our due diligence framework. So I don't think it's necessarily purely focused on fintech as a theme. I think it's across all industries and opportunities.
Oh, absolutely. Yeah, no, I agree. And yet it also clearly does come up in fintech too, right? I mean, we think about sort of blockchain technology and the sort of environmental costs potentially of, running the blockchain and doing transactions on it. It's a real component, potentially a real externality.
Yeah, it's interesting too, at least from a fintech perspective, thinking back to the first time, probably 4 or 5 years ago, I saw ESG come up. It was always much more in the context of constructing, individual portfolios and, how to create these indices that give you, a similar exposure that you would get with the S&P, but, take out certain companies that you may not agree with. And that seems to have extended now much more to like the enterprise side as well. And yeah, similar to Sean, we have a ESG checklist that we go through for all our investments. And so it is seem to be becoming much more commonplace.
Yep. And on the investing side, I mean, the rise and the power and the voice of the retail investor has clearly, shaped the way that the markets work today. So the only thing I'll add is we had a portfolio company in my last firm called Say that was focused on bringing that shareholder voice into the conversation. Whereas, previously earnings calls would all be dominated by the questions of, the large institutional investors of the world and analysts. Like now they're starting to help facilitate the process of bringing in, individuals and what the consumers and individual stockholders of that company want to hear and know.
That's terrific. So I noticed I'm getting some questions in the Q&A, which is great. And what we're going to do is we're going to hold those probably till about for about 37 more minutes till we've gotten about an hour into this discussion, and then we'll move through them, and then we'll use the Q&A as a means to channel and make sure that we're getting folks' questions answered. So continuing with the panel, though, I do want to pause just briefly and again have each of you sort of announce sort of who you are and what's the best way to contact you if folks are looking to reach out to you. We didn't do that at the beginning of the panel. I'm going to do it now, and then we'll probably also do it right before we pivot to the questions. But we've got a lot of entrepreneurs in the audience today, and will view us a little bit later, so it's helpful. Sean, looks like you're not on mute, so I'll let you start.
Yeah, no, please feel free to reach out. Always happy to have conversations, happy to brainstorm, happy to guide at least what my thoughts are on international, local, fintech. I can be reached over email. I'm at slee@mubadalacapital.ae, or just add me on LinkedIn as well, which is probably another easy path forward if you can't spell the full email address correctly, given it's kind of long.
Yeah, likewise.
Super.
Always happy to chat. My email is, you can reach me at emily@redpoint.com. So hopefully easy enough to remember.
Yeah, no, and similar. So my email address is david@gpv.com. And yeah, again, I'm pretty responding on all channels though. So if you want to just shoot me a LinkedIn or whatever, I'm sure I'll see it.
Super. All right. So kind of moving back towards the discussion, we started kind of touching on this, but kind of what some of the opportunities are that are coming out of this pandemic environment. I mean, what do you see in terms of medium and kind of longer term? What are some of the trends that are developing, whether it's sort of the use of AI or, continued disaggregation of what were otherwise sort of bundled services that you got through these bigger players?
Yeah, I guess I can start. I mean, I think the thing that I'm most excited about, and it's not necessarily a new trend, it's probably just an acceleration, which, continuing on that theme, it's more around, as software, is touching more and more corners of the economy. We're getting all these new vertical plays and the rest, different payment platforms that go along with that, whether they're embedded or standalone. And, there's a lot of thoughts, obviously Redpoint's invested in, something like Stripe, but like, other platforms that, maybe they can better service certain industries because, structurally Stripe's banking partners don't necessarily want them to go after those industries or what have you. So different, vertical plays like that in and around payments is what's really getting me excited.
Super. Emily?
Yeah, no, I think that is definitely a super exciting area. One of the things that is top of mind for me right now, among many others, is the idea of sort of fraud and identity. I think one of the biggest challenges of moving from an analog to a digital world is that, it's not your branch handing you my driver's license anymore and the teller looking down and being like, yep, that's the same person, right? I think criminals and fraudsters have gotten only increasingly advanced in the types of attacks that they're doing, whether it's, phishing and stealing your credentials or just buying it off of one of the many data leaks that have happened over the last couple of years. And so that is uniquely a solution or a problem that can be addressed by some of the most cutting edge technologies today, whether that's, AI and machine learning, and I think is well suited for technology players and startups to start thinking through. How do you balance at the same time not letting bad actors get through, but still providing a good customer experience in the sign up flow, right? None of us want to have to put in our information online and then wait a couple of days before we can open an account. That's just not what we're used to as consumers anymore. But so the financial services providers and institutions are trying to balance between, quality and speed, and at the same time not running afoul of the regulators, because that's definitely something you don't want to do.
Yeah, from my side, I would say David and Emily are hitting very important areas that we're also looking into. The only ones I would add are top of mind for me at the moment are continuing to look into different vertical finance and banking opportunities. What we're quickly realizing is that there is no one size fits all, especially when it comes to financial services. So how do we find different pockets of completely unmet customers by the traditional services today and capture those to provide the relevant rewards, the relevant products to help them become a better financial citizen. Brexit within our portfolio is obviously doing that with SMBs and startups. Welcome Tech is obviously doing that with immigrants, but I think there's plenty of other ones, including for healthcare workers too, the companies that provide, that I think is really, really interesting. And then the other thing that I would say we've had discussions internally about is we're always intrigued by all the hottest and the big brand name consumer-facing fintechs, but what about some of the more enterprise-focused ones that really help older legacy financial institutions operate and become better? We are on the mindset of, as much as neobanks and the new consumer-facing platforms continue to gain market share, at least in America, we don't feel like the older mid-sized or community-sized banks will ever go away. I think they're going to continue to play a pivotal role, in which case, if they will choose to do so, how do we make them operate better and compete against the fintechs of the world in the modern day? So very excited about that across multiple different avenues, of whether that's companies like Mansell doing omni-channel account opening, or Oculus doing incorporating AI to evaluate loan documents to extract information much more efficiently. Like all those avenues are things that we're interested in leveraging the latest technology to help these institutions operate better.
Yeah, Sean, I think that's a great point. I think a lot of people who maybe haven't spent time in the banking or fintech space are sometimes don't realize the extent to which a lot of the underlying technology is really old and broken.
Yep.
A lot of the core banking systems that our financial institutions rely on today were built in the 70s and in a language called COBOL, which is so old that you can barely find engineers who know how to work in it anymore. And so over the next, 5 to 10 years, like these systems are no longer going to be viable, and there's going to need to be some sort of a migration over to something more modern. However, that's like open heart surgery, right? Taking the core operating system of the financial world and making sure that that gets transferred over, correctly and in a timely manner with no downtime. And so we also have spent time thinking about and talking through like who are the technology players that can play a role here in the modernization of the tech stack, and how will that evolve.
So I guess maybe one question I have sort of uses what you said, Emily, as a jumping off point, which is, what has been your observations with regard to, not just you, Emily, the entire panel, folks who don't have a fintech background, kind of getting in and getting up to speed in this space, in this vertical? And what have you seen that's been sort of successful? What have you seen unsuccessful? Kind of what kind of things or tools or resources are out there to help entrepreneurs, because we've got a lot of first-time entrepreneurs here, get up to speed in this highly regulated, high stakes environment?
Do you want me to start? I can.
It's open.
Yeah.
Or if it's a terrible question, you can tell me that too.
No, it's a great question. And I've found that, oftentimes people who come to financial services or fintech from an outside perspective have a much, have a unique way of understanding like how things could be without getting bogged down in how things have been, right? I think those who have grown up in, and on the flip side, I've also seen great entrepreneurs who've grown up in the financial services world. But with just banking as an example, a lot of people who are traditionally came from financial services think about things in silos of deposits, your loans, your credit card, and your mortgage. Whereas I've come across entrepreneurs who were from more of a tech background who are like, why do those have to be separate? And well, you dig into it and it's because, well, historically the technology and tech stacks were separate. But that doesn't necessarily mean that's how I think about, my life and my finances as a consumer, right? And so that's kind of one benefit. I guess the only other, on the flip side though, the advice would be like, move fast and break things doesn't work as well when you're dealing with people's livelihoods. So hire someone with a good compliance background and deep regulatory understanding earlier than you think you will need them, because you do not want to have to need them after the fact.
Yeah, I agree with that. I feel like every single person has their own secret sauce. Like as all the founders that we've met, it's incredible, and I'm always humbled by the level of knowledge that they continue to gain. But when it comes to fintech, Emily's hitting the nail on the coffin, which is stay close to regulation. You'll notice one thing we've noticed across all of our own portfolio companies, there's consistently a high demand of talent for chief compliance officers. And there's a reason why, because if you touch banking, if you touch capital markets, as much as things may sound simple and as much as things should be in a certain way, it is not on a regulation side. So staying close to it and having a thorough understanding, whether that's having conversations with us as investors who live on a day-to-day basis around these topics, or having discussions with compliance officers or lawyers, are critical even at the early stages of development.
David, any other thoughts or comments, or any other sort of concrete tips as to how to get up to speed and how to find that talent, whether that's accelerators or incubators focused in this area? Or
yeah, the only thing I'll add is, I think at a certain point, you just got to dive in and then just really make sure that you understand the history a little bit, touching a little bit on what Emily was saying about why things developed the way they did. And then you'll get usually a pretty good understanding of, okay, like she was saying, oh, this tech is super siloed, or what have you. Okay, so then starting from that point, jumping forward, and a lot of times there's structural reasons why things are the way they are, and so it's a bit difficult to overcome that.
Yeah, and the great thing about the financial industry is that it's super learnable. There's a lot of great books and resources out there. I'll just plug one. Payment Systems in the US is a comprehensive guide for everything you need to know about, how and why the payment systems are the way they are today. And so there's no shortage of resources on either online or that you can find that'll kind of help you navigate the world.
So if I can maybe summarize and maybe underscore sort of a learning point out there, which is that investors are going to be looking at this aspect and looking to know that you've done your homework if you're a first-time entrepreneur. So when you come to them and you're seeking to raise capital, you got to know what you're talking about, and you got to have a plan that they can understand and kind of get behind. The three of you are free to disagree with me, but I probably doubt you will.
Yes and no. So I guess I would say,
fair enough. Yeah.
If you came to me and you told me that I wanted to rebuild the banking fraud system, okay, I would hope that you had a good understanding of compliance and AML laws and at least some sort of a background in history there. But there's also a whole host of entrepreneurs who started somewhere else, maybe like, hey, here's a platform that I want to use to help individual creators run their businesses. And now they're starting to think about, how do I add in financial services and products in there? And in that case, as an investor, we're very much happy to help them think through the regulatory requirements and what they need to understand about the financial services industry to be able to do that. And so I guess it's more of just a question of where did you come from, and what kind of financial services you're looking to address.
Well, and it might also be kind of stage, right, with the company is at. And so maybe that's a wonderful segue, Emily. I love it. You just keep, maybe we could talk just a little bit about the sort of the landscape for first-time entrepreneurs because we got about 50% of them in the room. Who's the typical first money come from? Kind of what's next? What are the metrics that maybe your first real true venture capital financing, what's that going to kind of look like potentially in terms of who are those investors and how much are you looking to raise? Open question.
I don't think there's the letters of what we used to consider Series A's, B's, and C's have any meaning anymore, to be honest with you, especially in the past year of how quickly fundraisers have happened, how you see $20, $30 million seed rounds and what used to be known as a Series B, right? So Jason, you make an important point, which is I, on behalf of Mobottle, generally play more on the early growth side of the house, which means we focus on the Series B, C's, and the D's of the world. So the typical entrepreneur that we would meet are have had multiple fundraisers generally in the past and are looking to really put the gas on the pedal for continued growth and hyper growth. But when you take it back a couple of years and let's say you look at the traditional framework of venture financing, you've had your friends and family rounds, the pre-seed, seed, Series A, B, C's, and D's, and so forth. At least from my side, I wish I can give you the golden metric of what we hold every founder to in terms of ARR or the number of logos that they have on the customer side before we would get excited, but I just don't think that's the right way to approach investments, frankly. I think it really depends on a variety of factors. To Emily's earlier point, the background of the founder and the relevant history and the knowledge, as well as the rapid growth that you might have experienced in the past couple of months versus the past couple of years. Like all those things really come together, which the crux of the point that I'm making is at the end of the day, it's storytelling, which as an investor, that's what we do. As a founder, that's what you do. So, but the general trend you will notice is that the rounds are getting bigger, rounds are happening faster, and it's just a question of where you want to play in that ecosystem and how fast you can move.
David, I saw you were shaking your head.
Oh, no. Again, not shaking. I completely agree. I guess I'm coming in a little bit earlier than Sean. Like I'm coming in like seed through Series B, and so probably not Series B, but it's seed and A. A lot of the times you really are buying into a narrative that the entrepreneur is telling you, okay, this is the state of the world, this is the solution I'm proposing, and, post implementation of my solution, this is how things are going to change. And then past that, again, there really isn't any sort of cold hard numbers to a lot of it. I think a lot of, in terms of what investors expect, I think it's a combo of founder background, competition that they see in the market. And, the more competition they see is in the market, probably the more traction they're going to want to see to show that you've differentiated from the competition. Then also just size of the opportunity. If it seems like one of these new blue ocean opportunities that's, going to be absolutely massive over the next decade, people are willing to make a really early bet on it just because the upside is so large.
Yeah, no, I think I totally agree with that. It's a tough question to answer, and I think, but it's the one that, a lot of early entrepreneurs care the most about. Like, okay, what are the concrete things that I need to have happen? And investors always kind of waffle on, hey, we don't really have hard metrics or what we're really looking for. I'd say piece of practical advice in terms of, your earliest dollars into the business. There's a lot of, strong, fintech focused accelerators that I've seen pop up over the last couple of years, as well as just a really good corpus of ex-operators who have now turned to be very active angel investors. So think of like the, ex-Stripe, ex-PayPal kind of backgrounds who are, very vocal and supportive of the next generation of fintech companies and can be very additive, both investors and advisors on your cap table. And then the other piece that I was going to say is kind of like over the life cycle of a business, what investors look for really evolves. I think the later you go, the more it becomes about, metrics and growth and how many customers do you have? What does your business model look like? At the earliest days, it's exactly what David was saying, right? They're looking for some very, determined and entrepreneur who's trying to tackle a big problem and a big opportunity. And we're willing to, for the right, people or background in the right kind of industry, make a bet, even if there's not much of a practical sort of metric or business to look at.
So I liked, Sean, that you and David use the narrative sort of as the word, because that's something that I use sometimes too. I usually say you got to build a credible narrative. I'm sure you were thinking the same thing too. Mm-hmm. But so it's not just a story that you pull out of thin air, but it gets sort of backed up, by data and your plans and those other things, which is all of what you all were mentioning before. I guess shifting the conversation a little bit, and what I want to maybe drill down on is maybe some emerging technology that, or what you're seeing in terms of emerging technology that you find exciting. I don't think that we've sort of talked kind of on that yet. If this were 2017, we'd probably be talking about blockchain. But, and then 2018, 2019, AI and big data and maybe edge computing at this point. Maybe it's still all of those things, but, is there emerging technology that you think is completely new or has been around for a short period of time that is yet to be fully exploited or harnessed that gets you excited? Open question. Yeah.
Yeah, thinking. It's a good one.
Yeah. I think, I don't know, I correct me if I'm wrong, guys, and you guys may have different opinions, but I feel like we're in an era where it's not the newest technologies that's grabbing attention, but the relatively older technologies that we've had buzzwords about finally maturing into existence and finally seeing more use cases and applicability. Obviously, AI has been continuously hot, but we're noticing how is AI more seamlessly integrated into the various fintech offerings that's happening today and used in the right format and the right areas of interest, and same with blockchain too. Obviously everyone's talking about the craze of crypto these days and the rising prices, but you'll notice that this time around is perhaps slightly different than a few years ago, where enterprises and large organizations are buying up crypto, are putting up loans to be originated on blockchain. So I feel like we're at the moment, I would love to actually learn about this if there's any latest technology that we should be more aware of, but I think it's just the maturation and advancement of the older ideas finally come to fruition to be used on a day-to-day basis.
Yeah, I think I agree with that. I think, my observation is probably that, unfortunately, for better or for worse, like the newest, most cutting edge technology usually takes a little bit longer to reach financial services, just because there's so many questions and difficulties around, tweaking one little thing. Like there was the whole, controversy a couple months ago around, Apple Card and their underwriting system, and did it favor, men over women, and like just the need to have extremely auditable, trackable decision-making processes in the financial services space is so important that it has been more difficult for, solutions that rely on many times like AI or machine learning or something that is a little bit more of a black box, to really see that kind of adoption. I think it's starting. I think, big data analytics is something that's certainly talked about a ton, and we'll start to over time see the cutting edge technology reach the financial services sphere. But I think they're going to go address other industries and other problems maybe a little earlier.
Yeah, no, I mean, if anybody has any of these new technologies out there, please let us know.
Yeah,
it'd be great.
Yeah, we're all ears.
No, I love that. I feel like sometimes, especially when I talk to entrepreneurs, they sort of say, what do VCs want, or what are they looking to invest in? And it's like, no, that's your job. Your job is to come up with the ideas and bring it to them and then sell them on that. So open plug for communication, which is maybe a good way to, again, just give your contact information, if you wouldn't mind. We can just go around the horn real quick. David, yeah.
David@gpv.com is my email.
Super.
I am Emily at Redpoint. That's redpoint.com.
Super. Oh, go ahead.
SLEE at Mubadala. That is MUBADALA capital.AE.
So what are you seeing in terms of the trends in venture, and then also more specifically within the fintech vertical, in terms of levels of investment, the stages at which investment is being deployed? And where's that sort of been, and where's it headed, at least in the short term?
It's hot. I don't know how else to say it.
Please throw that softball.
No, how else to put it? It's mega hot.
I think at least here's my I always look at some of the amount of funding that goes on across fintech, from different publications, and you see billions and billions of dollars being deployed every year, but you consistently notice a massive jump actually from about 4 years ago. 2017 was hot, but 2018, 2019, 2020 are looking continue where super, super hot. And part of the reasons why I think so is we were starting to finally see some validation in the public markets, as well as through a couple announced M&As. And that's showing a signal to both the investors as well as to the entrepreneurs that there is a massive potential exits ahead for some of these companies. So we picked up interest from first time fintech investors, as well as continued deployment from traditional legacy fintech focused investors into this market.
Yeah, I mean, it's also just a 180. I mean, even from like 8 years ago, there weren't really many fintech exits that you could point to. And obviously that's completely changed.
Yeah, I think totally agree with what everyone has said. Just a personal anecdote, when I started investing in fintech a couple of years ago, I would tell people that, and they'd be like, okay, cool. you do you. And now it seems like, every fund and every shop is actively looking at fintech or have someone that's focused on the vertical in the space. And a lot of it is because of the validation from the public markets and some of the exits that have been seen. And I guess the one other point that I'd just like to bring up briefly that I know Sean has talked about a little bit is just that it's also increasingly global. So, we're starting to see a lot of investment activity happen in Latin America and Southeast Asia and Africa. And I think that comes from, people understanding that the way financial services develop in some of these areas is not necessarily going to look like what it looked like in Europe and in the US, and it could be something totally different and tailored towards the local populations and communities. And but there's massive opportunities to be built.
So I want to pick up on validation because each of you said it. So I want to ask a little bit, maybe unpack that a little bit for the folks who are attending, which, maybe talk a little bit about why that's important, perhaps in the context of what your investment horizon is, and also maybe some of the downstream effects that Emily talked about earlier in terms of there being educated angels in the space, and kind of how the synergistic effects that sometimes has.
Maybe I can start. I mean, I think it goes back to more around like 2008, 2009, where just in terms of like regulation, it was much more favorable towards larger banks and financial institutions. And then post, the crisis, the pendulum seemed to swung the other way in terms of, regulations more against those larger financial institutions. That sort of paved the way in many ways for some of these, startups to come in and gain a lot of traction. And, if you just think about, venture cycles, it, take 10, 15 years or so to really sort of see the results of, some of these startups getting off the ground and exiting. And so I think in many ways, it's kind of like go back to the crisis, fast forward 10 years, we're really starting to see fintech as an ecosystem really come into vogue.
Yeah, I think that's exactly right. I guess in terms of validation, look, I mean, there's always was this question of like, hey, if you look at the public markets in the way that, a traditional bank or an insurer is valued, it's typically, 1 times book or whatever, right? And there was a question of like, as these companies hit the public markets, are they going to be seen as tech companies, or are they going to be seen as financial services companies? And, jury's still out, but early indications seem to suggest that there is a premium or a multiple that it looks closer to a tech company, and gives them the credit for that. And so I think that has created a lot of downstream effects in terms of investors being more comfortable in that you can build, big businesses and attractive outcomes in the next, 7 to 10 years in this category, as well as, giving some of the early employees at the Coinbases of the world the ability to go out and start seeding the types of businesses and being active investors in the ecosystem.
Yeah, nothing more to add. I guess just one data point to share is 2 years ago, if you look at private versus public market valuations in fintech specifically, public markets are actually valued lower than private market valuations. You look at now, as well as years ago, public's much higher than some of the private market valuations that we're trying to catch up to. So that's just another sign of validation, right? Emily's hitting a point, which is, do we view them as technology companies? Do you view them as traditional, just pure financial services companies, or are they a mix of both? Or the big question is, what can they really become 10 years down the road? And should we be really capturing and underwriting our thesis based on a future 10-year, 5-year multiple? But as an early growth investor, it's constantly a topic of debate amongst ourselves. And how do we really value these companies, especially as some of these rounds are happening with minimal revenue or minimal traction? A fun joke that we always make amongst ourselves is the companies are like, oh, we have revenue, and we're like, well, what is revenue? What does that even mean anymore to us? That's just the reality we are in. So I would recommend to founders, I would recommend to entrepreneurs about, think carefully about monetization, think carefully about what traction means to you, and what are the right metrics you want to go after first before hitting some of the fundraise cycles.
Well, thank you. Well, I think we're getting down towards the end of the hour together. So what I want to do before we pivot over to the Q&A is just, have each of you, if you've got anything to say, any advice or tips or tricks or any other pieces of information you want to leave, for the audience, in about a minute or 90 seconds, if you'd share that with them now, that'd be a great opportunity to do that. Maybe David, we'd start with you if you're ready.
Yeah, I mean, I don't know if it's a trick, but I mean, I think in terms of, if you are planning on approaching investors and going the venture route, just starting those relationships early. I mean, a lot of investors, especially, I guess the three of us around the table are more coming in, I think, at like Series A and beyond, but just because, an investor may not invest at that time doesn't mean it's not a good time to start that relationship. And it's just going to make everything so much easier down the line once it actually comes time to, you're in that investor sweet spot.
That's great advice. We'll mark that in the record. Sean?
It's sort of related, but not just with investors. I would say talk to as many people as possible if you're a first-time entrepreneur. Like you'll be surprised how helpful people can be, and you'll be surprised also at the same time how many people are now calling themselves angel investors or advisors,
or VCs, or VCs.
But a lot of people, you'll notice after the first 5 to 10 minutes, they'll be genuinely interested in either helping you out or genuinely interested in hearing your story, because they themselves have taking out the monetary interest of an investment or whatnot. They're genuinely curious. They want to learn themselves to and share what they've learned. And founders have gone through troubles themselves, learned a lot, broke a lot, and figured out the right strategy. And they'll be willing to share that to you so that you don't have to go through the same problems and the hurdles before hitting the jackpot. So I would encourage to have as many conversations as possible as soon as you start exploring the idea.
Yeah, I guess from my end, 2 reactions and one thing to add. Like, 100% agree with what David said. Build those relationships early. At the end of the day, most venture funds are investing in you, the entrepreneur, and we want to make sure that we understand you as a person, right? Because companies can change, markets can shift, ideas can evolve, and it's not necessarily the deck that you come in with or the idea you come in with on day one that is what the company ends up being. And so we just want to know that this is a person that we want to be working with for the next however many years as it takes to get to an exit, and that we would be happy to work alongside. And then my second point, which was going back to what Sean was saying, is like absolutely talk to as many people as you can. The one caveat, or not caveat, the one extra piece on top of that I would say, and particularly in financial services, is it's very important to get the view of people who work at the incumbent banks or are entrenched in the system, but I wouldn't over-index to what they say all the time, because I have in many times or ways been, even from the investment side, steered wrong, where I talk to someone and they're all like, oh, that will never work, that doesn't make any sense, and it turns out that they were wrong, or a little bit behind the curve, or stuck in their ways. And so have your strong thesis and point of view, get all the feedback, but still make the ultimate call or decision on your end. And then I guess the last piece of advice, which is really more of just a plug for Jason, is start thinking about the legal side of things as early as possible, and make sure that you have all of those ducks in a row. I have friends who were early entrepreneurs and had to deal very early on with issues around co-founders leaving or things like that, and it's always better to just have the right frameworks and things in place for when things go wrong.
Well, thank you, Emily, and thank you, all of you. I mean, that's excellent pieces of advice, and actually we'll return to maybe some of that during the Q&A. But we've now reached the hour mark, so I want to open up the discussion to the audience. So, audience, if you've got a question, please use the Q&A function. We're going to try and answer the questions that are going to be applicable to the most number of people in the room. So if you've got a really specific question, that's probably going to fall in line a little bit behind questions of general applicability. So with that in mind, let's take a look. And panelists, feel free to take a look because I think you can see the Q&A as well. We've got, and crypto always comes up. We talked a little bit about that beforehand, but we've got a question about how reliable cryptocurrency is as a form of payment and security and investment. I don't think any of the panelists play specifically in that space, but if you've got any thoughts and you want to share, maybe that can be our opening question.
Yeah, it's just a super basic kind of response, but I think it's very different to think of crypto, the viability of crypto as a payment method versus an investment, right? I think the latter maybe has been, more or less proved out that this is an asset class people care about. It's increasingly institutionalized in terms of how traditional financial institutions are thinking about offering it or providing it to their customers. But I think there are still too many frictions in the way that it works today, just from a transaction fee perspective or from an accessibility perspective, that makes it hard to be used as a currency, which it was originally, sort of intended for. That could still happen down the road, and there continues to be innovation in the space, but it just has not been proven out yet.
Thank you. So we've got a question I think is maybe related to what I believe, David, you were talking about, which is you're starting the communication early. Kind of what does that look like? How is it, especially kind of in the pandemic and maybe coming out of the pandemic, how is that, those initial intros, how are they formed, how they start, how does that conversation continue?
Yeah, I think there's a lot of ways to go about it. I mean, VCs are, for the most part, pretty receptive to taking initial conversations. It is our job to speak with entrepreneurs. And I think for the most part, people who do it, really enjoy it. Whether it's warm introduction through, just someone you saw that I'm connected with on LinkedIn, or you just reach out directly, say, hey, you seem to invest in this area. Like, I'm building something here, would love to chat. I assume all of that's going to work. And then past that, it's kind of up to you to just figure out the cadence with which you think it's worth keeping up, whether it's, monthly emails that you send out to your existing investors and, maybe take out some of the, stuff that you want to keep confidential, but just shoot, hey, look, these sorts of things have happened over the last month. Just wanted to keep you up to date. People are going to read those emails, and I think you'll be surprised at how much people keep up with that sort of thing.
And maybe on a related note to what Sean was saying in terms of sharing, what does that look like in terms of the level of sharing and depth, that you'd expect to see as an investor, kind of, and depending upon where you are in the conversation. And I'm sorry, I'm trying to also run the tech in the background, so I'm not ignoring the panelists. I'm just looking at the chat function and trying to square everything here.
It's actually a good question, Jason, because I was actually reflecting about some of the monthly emails I do get from certain companies that we've actually passed on. And while they might look like a generic email that's sent out to all the investors, but the things that we continue to get enraptured by are things like, look at the transaction volume that we've done month over month and the growth. That's not necessarily too private, but it continues to keep the investors on their toes as they think about, wow, did I miss this opportunity? Or wow, what's really changed since our investment or our past that's making this company work? Things like product development, also things that we look for. But frankly, don't even use it as a chance only to notify the investors, but ask stuff from us too. Like, that also gives us a chance to validate and prove to you as an entrepreneur that we have the right resources to help you as the right partners for further stages of growth. So ask for I think the best way to structure certain emails are, TLDR, this is the information, and then have a highlight section, low light section, be honest about things that's not working well so we can also help you, and then ask us about, we're looking for a chief compliance officer, please send over a couple of recommendations if you have any, or we're looking for a new office space in the marina or the SF area. So all those things could serve multiple, that single email could help you in a lot of different ways. So, carefully craft that and do send it out on a monthly or every 2 months or so.
Yeah, I think it's been covered really well, but the only thing that I would say is on the building relationships with investors side, there's like some pre-qualification that you can do in terms of, looking at the stage that they focus on, or the types of things that they've worked with in the past. It's not always the best indicator, but it is helpful in terms of understanding where they might be spending their time. Like, for example, I sit on the growthier side of the Red Point house, and so will maybe be a little bit less helpful for someone who's at the very earliest stages of ideation. And that's just not the kind of specialty or what I have seen necessarily before or as much. And so that's one tip on that piece. And then in terms of the weekly or monthly updates, I love getting those. I think it makes me really feel closer to the entrepreneur and the business. And as investors, we're not only looking for like the good things and the highlights and the pitch decks, right? When we're getting involved, there's always going to be risks, and I'll want to know what those are, and be able to get comfortable with them. And so, be very honest in sharing, like, hey, here's what's going well. We launched this new product. We fixed this bug. We landed this new customer, but also what's not going well. We're struggling with, filling this one seat or whatever. And I think I tend to find that people are willing to be open with their networks and people that they know to help. At least I am always happy to try and help in any way that I can.
No, that's terrific. I mean, I think one thing that I sort of generally advise is just, investors are people, right? And so how do you build a trusted relationship so that you're going to get, what you need when you need it? That is, you got to build that rapport with them, and you build that rapport by having communication in a low stakes environment where, you're not making an ask. And they can get some insight into that, and maybe also kind of buy in terms of giving some feedback or input, or start to build that trust. You mentioned stages before. I feel like we kind of touched on this a little bit, and Sean gave a very apt and accurate statement, which is, what are the names of these financings? It's all branding at this point. Or that's what I say. I think, it's just, whether it's a Series A or Series C, it's just branding. But I do think, at least in my observation, it seems like, friends and family are the first couple hundred K in the door. Then you're maybe in Angelville or Super Angelville, maybe some micro VCs will come in the first couple million raised. But then after that, you're starting to be kind of with more institutionalized investors. I don't know if that jives with how you're continuing to see this space. I'd be interested in hearing the observations of the panel.
That's the general framework, Jason. I think that's accurate.
But you can't go by the names.
But you can't go by the names, because names are not meaning anymore. Yeah, look, I think if you take the traditional standard, by the time you reach Series A or Series B or Series C, for sure by that point, you should have certain amount of traction or data that you can share with us. I would say, especially when you're looking at Series B opportunities, we would expect you to not only have revenue coming in, but cohort data, solid monetization strategy, up and coming product roadmap that you are already on the path to delivering and executing on. So that's generally where we personally play, and we need some data to work off of that. But the general framework, to your point, Jason, is how you just laid it out: friends and family, angel, seed, Series A, Series A-1, A-2, A-20, Series B, and so forth.
Yeah, maybe just the kind of rule of thumb or a specific framework that how I like to think about it, even though we kind of live in a post, stage, post round world these days. The very early days in terms of, friends and family, that's really just getting the startup money that you need to start building the product and the company, right? I think by the time you get to what would traditionally be more of your Series A, you're starting to think about like, okay, maybe I have a solution or something that I have, and we're gonna look for product market fit, right? And so what this capital is going to give us the resources to do is to go test out our market hypotheses and see, if there is validation. And then as you go a little bit later, Series Bs and beyond, usually the way that at least we think about it at Redpoint is you have hit the earliest stages of product market fit. There's some customers that are using your product that really like it. And the next step is thinking about like, okay, how do I scale up and create the organizational infrastructure that is needed to support the next phase of growth, right? Whether that's building out a sales team or building out a marketing function. And so that's kind of how I think about the different capital raises at different points in the life cycle. And at each of those, sort of middling to later stages, you're also bringing on a person, typically from your investor to your board as well, right? And so it's kind of institutionalizing the governance of the business, but also adding another voice around the table in terms of driving things forward.
Thank you. So maybe we'll, unless there are any other comments on that, I mean, maybe we'll kind of pivot. I want to answer or ask the panel this question, which is, earlier in this discussion, we were talking about how, especially in the last 10 years, the world has become flatter with regard to access to capital and flow of capital. I think each of you in the Bay Area right now? Or you're in?
Supposedly.
Yeah, supposedly. More or less, close enough. What are you now? So what does that look like? Are there companies outside the Bay Area getting funding from Bay Area VCs, the other way around? How's that sort of, evolved in the last couple of years and maybe changed through the pandemic and coming out of it?
Absolutely. I think we are starting to realize that pockets of opportunities are emerging in different geographies, where you need either perhaps a similar product that's worked in different geographies, but with a more localized approach. That's why you see so much investment already going into Latin America is one geography, at least obviously representing the Middle Eastern side of the house. Given we're from the bottom up, we're seeing tremendous opportunities of foreign investors coming in, piling capital into startups in the MENA region as well. I think you'll notice that a lot of the funds are continuing to take a global approach in investing, and that's something that we take pride on as Mubadala, but a lot of our friends have also decided, yep, we used to purely focus on North America, but now we're going to look at different geographies as well. Some are choosing to partner with the more local regional VCs before making investments, but I think things have dramatically changed in the past 4 to 5 months, where people are comfortable leading rounds left and right in different geographies too.
So sort of a follow-up is, how has that changed, or the sort of nuts and bolts of the mechanics of, getting to build that trust and rapport, and then also diligence on these startups? I mean, I sort of presume there hasn't been much travel for you all in the last 14 months. Maybe that's starting to change a bit.
Yeah, I guess the comment I'll make is like as zoomed out as I think everyone is these days.
Yeah.
It actually has been a boon for, I think, entrepreneurs who maybe like weren't necessarily in one of the big tech hubs, right? And it's shifted the mindsets of VCs across the board. Like even a year ago today, I was still having conversations with other investors who would say things along the lines of like, well, we would, never invest in a founder that we'd never met in person, right? And I think that that mentality has, completely gone away by this point. And it does create a little bit of extra lift in terms of the types of diligence that we need to do to make sure that we get comfortable, and it helps, I think, in the further you are away from home, to have had that relationship for longer and been able to kind of see the business grow up a little bit more, but not a major barrier.
I mean, the only thing I'd add too is that, a lot of the accelerators and incubators that VCs are used to working with are also expanding to other parts of the US, of course, but then internationally as well. And so, a lot of these stamps of approval from, just sources that VCs trust are expanding. And so then the VC expands with it, so I'm like, oh, wait, no. I think that's happened too over the last few years.
Yeah, I mean, that's been a really interesting and exciting part of the ecosystem, probably even over the last 10 years, right? It's sort of the advent of the incubator and accelerator and the sort of like making it much more professionalized and formalized than it sort of had been before that. And it's just that's a trend that's just really accelerated. And I've noticed that. So we've got maybe about 10, 15 minutes left. I want to make sure. We've got a bunch of questions. I want to try and again focus on the ones that are going to have the broadest applicability, but I'm going to give each of the panelists a moment to take a look through them if you haven't already, to see if there's a question that you are dying to answer. And if not, I'll just keep asking questions. Dying to answer is not right, but if there's a question you think needs to be answered. Maybe
I saw a question on cash usage.
Yeah, go for it.
Sorry, Jason, go ahead.
No, I mean, I was
just saying, I saw a question around cash and what.
Oh, or was that in the chat?
I don't know. Maybe I'm lagging, Jason. That might be on me. Sorry.
Yeah, no problem. Maybe I'll ask an interim question, which is, there's a question of general applicability in terms of intellectual property and kind of where that fits in the calculus of you making investment decisions. I mean, I think to a certain extent, maybe the answer is going to be it depends, but sometimes I think it's very helpful for entrepreneurs to really kind of understand the lens in which you make decisions so that they can provide the information that's necessary for you to figure out if it's a good investment for you or not.
So Jason, you were asking about our framework of diligence?
Yeah, so kind of in your framework in making an investment decision, where does IP fit in there? Where is it important? IP is everywhere, right? Whether it's even just branding, that's IP. It's maybe not technical patents or whatever, but where does that sort of fit, and where is it maybe more important in some places than other places?
I mean, I guess at least just personally, I kind of think through a lot of investments, in three ways. So obviously like growth of the business, and then, can they extract some sort of margin eventually, and then, some sort of defensibility around it. And so for me, like the IP would fit into that defensibility piece. If there is some sort of technology that, they have that other people can't or won't be able to catch up to for a few years, whatever the case is, I would kind of bucket it within that sort of framework.
I think that's right. That makes a ton of sense. I think just very practically, I don't tend to over-index to patents. I think as a venture investor, at least, like what we're looking for at the end of the day really is a technology solution that solves a real pain point that customers are willing to pay for, or can be monetized in some way, shape, or form, right? And so if it is like the most, cutting edge breakthrough technology, but no one wants to buy it, like at the end of the day, it's not a great investment, right? And so it's important, but it is kind of one factor of a bigger picture.
That's great and accurate. And I think one sort of follow-up question is that someone had is if it dovetails with our discussion in terms of stages, and you think about the evolution of the company and who's kind of playing in what stage and what investments they're making. But in terms of MVPs or minimum viable product, where do you sort of typically see that sit in the life cycle of the company, and what kinds of investors are looking for that MVP?
Yeah, it's a good question, but it's tough because I think it varies from opportunity to opportunity a little bit, and space to space. If you're building a consumer facing service, like probably better to have an MVP sooner rather than later. If it's something that might be a bit more of an extremely complicated, very technical build, like it's fine to be, a little bit earlier on in the product development life cycle at an earlier stage, right? But typically I'd say that at the latest by like the Series B or maybe even before your Series A, you want to have a product that is tangible and that people can kind of look at.
Great. So I don't know. So I gave you all a moment, although I was talking during most of it, to take a look at some of the questions and see if there's anything you want to answer. I'll pause here to see if there are any, and if not, I've got another question or two I can ask, and then we can again maybe go around the horn, if you will, and have everyone give their name and contact information and what they're interested in. Yeah, it's hard because we have a lot of questions in here, but many of them are not sort of generally applicable, and we've got a large audience, so I just want to be mindful of trying to add the most value across the greatest number of people.
Yeah. I guess if someone's charging you or collecting fees to connect you to investors, don't do it. I see that. Seems like not credible at all. Sorry, I'm just kind of scrolling through.
No, I was laughing because it is there are specific regulations that deal with these, the broker-dealer regulations, those are part of the securities laws. And if you don't, if you're not in compliance with that, one, you may not get the investment they're seeking to make, or, it may be maybe even more expensive to get it done and get it done correctly, or you may need to wait a period of time. And so, unless, they're a registered broker-dealer, probably is not going to be the right person to go with. And there are a lot of people who are making promises in return for some equity. And if they can't, and even worse is if they not only unlicensed, but you now have got this piece of paper where you said you promised something to them, that's even more of a mess to try and clean up. So I was laughing, not because it's funny, but just that I've experienced it so many times and tried to avoid people experiencing it. That it brings up a lot of memories for me, not all positive memories. So stay away from those folks, or make sure you've engaged counsel to properly vet the situation before you sign it. Because it can be done in limited circumstances, especially early stage companies. Later stage is a little bit different.
Totally.
So sorry to just kind of go on that little soliloquy, but
yeah, there's a question in here that may be interesting for us to talk about, and would let Sean and David comment first. But there's about like, hey, should I take advantage of the funding environment that's going on right now, and raise more capital at a healthy valuation and great terms, or should I wait a little bit longer and prove out my product more and get more proof points? I think that's a common probably debate that entrepreneurs have, and so I think that it's worth talking about.
I just got like 4 calls in the past week about this little topic. I'm sure David and Emily felt the same. Unfortunately, I hate giving mixed answers, but I would say it really depends. Yes, it's a healthy environment. Yes, if you want to load up a little bit of a cash balance, knowing that you have a little more development ahead, or you have strategies to test out, then sure, this is a great time to fundraise off of your accomplishments already. But just taking capital for the sake of taking capital, I don't think is something I, as an investor, would recommend. It's a healthy, frothy valuation market, but we also have to think about the situation of what there's a downturn, in which case, when you actually do need to fundraise, you might need to go out at a flat or down price round if you don't have the milestones is clearly established and you've met them to the dotted line. So unfortunately, I would say again, it depends, but that's been the advice that I've been giving so far to some of the founders that I've encountered for the past week.
Yeah, and I think also just from a VC perspective, just be careful, because I'm sure or I shouldn't say everybody, but a lot of companies get a lot of interest and inbound from VCs, but just because they say that they're interested doesn't necessarily mean that they're gonna run a really fast 1 week process that will be no brain damage for you. A lot of times they'll kind of get you on the hook and then run their normal process. So just be careful about that.
You should also think about they do run a week-long process, and if you don't have a long-standing relationship that you've built with us, think about if this is the right partner you want to have around the table. It's diligence periods have been getting shorter and shorter, and I think partially for the right reasons, but also for the wrong reasons too. So think very carefully about who you want to add to the cap table. It's not just capital you're adding on. We like to say adventure. When you're investing in a founder, you're technically getting married to them for the next 10 years or so. So think very carefully.
Yeah, that's great advice. Do homework on your investors. I think it's a pretty small community. It's growing for sure, but there's a lot of things that you should look out for, or things that you should know. You should absolutely ask to speak to references of portfolio companies, things that have companies that have done well, but companies that have also not done well. And it can be, exciting to get a good offer at a healthy valuation. But again, echoing exactly what David and Sean said, like make sure you know who you're working with.
There's a question around. Sorry, go ahead, Jason.
No, I was just going to add, the data is out there, right? Whether it's sort of PitchBook, Crunchbase. You may not be able to find every single investment that an investor has made, but you can get a flavor of the investments of what they've made, if there are serious players in the space, and that's available. So you can run a little bit of your own diligence process.
I think there's a question around whether you need a pitch deck presentation to introduce an idea and how long it takes to reach a decision. I would say personally, I think it's actually really important for David and Emily to contribute over here, but it really depends on the firm. But on our side, we don't require a pitch deck or a presentation. I personally like them only because I look at it after the meeting to recalibrate my notes, recalibrate my thinking. So that's the only value I see it. But to be honest, if a VC says, please send over the deck and it's a requirement, it depends on the shop, but most of us do not require that. And from a due diligence time, really depends. We've reached decision a couple of days, 1 week, 2 weeks, depends on the firm and the opportunity and how much work there needs to be done before or after the process is kicked off.
Yeah, I agree. I don't think I ever go through a deck on the first meeting. I always try to keep it much more of a casual conversation, get to know each other first. That being said, a deck can be very helpful when I am also trying to share the idea with the rest of my team. I can wax poetic, for half an hour about what you do, but if I can just send them a couple visuals about it, then that can also help grease the wheels for internal conversations and making sure that a VC can get their team around any idea.
Yeah, nothing to add. It's helpful to have materials and references to be able to look at. And I guess timeline wise, it really depends on things that may be out of your control. It could be like if it's a space that me and the team have spent the last year looking at, and we were just looking for this one thing, like, hey, we can move as quickly as a couple of days. But if it's something totally net new and we have to get up to speed on the market, and we try to be as open in terms of communicating that, as well as, working with whatever timelines the entrepreneur has for their funding round. But it can very much so vary, I guess, is the bottom line.
Well, thank you. Thank you, panel, for your time today. It was a great event. We are coming up on the hour-and-a-half mark. I think at this point, I'm going to close it unless anyone has any other thoughts or comments or wants to share anything else. Nope. I want to thank Emily Mann, David Reznikov, Sean Lee for attending today. I want to thank Idea to IPO for hosting and organizing today. I want to thank each of our attendees for showing up. This again has been recorded, so we'll follow up with the video in the next week or so if you haven't received it by then. I'm Jason Putnam Gordon, and if you want to reach me or connect with me, LinkedIn, and I also keep office hours too. So again, thank you very much. Going to let these VCs get back to their board meetings and take in meetings, and I'm going to let you get back to building your great company. Thanks a lot. Take care. Bye-bye.
Thanks,
Thank you.
everyone.
Right.